stop what you're doing. Something massive already happened in the silver market. You didn't see it on CNBC. It wasn't a headline. It was structural. JPMorgan, the same bank that spent years as the most notorious silver bear on Wall Street, now controls an estimated 750 million ounces tied to COMEX-linked channels. Not shorting it, holding it. Let that sink in. The historical suppressor became the dominant accumulator, and they did it while everyone was watching price. Here's what matters right now. Silver is no longer trading like a sleepy commodity. The structure underneath shifted, fast. Price still looks calm to most people, but flow control is tightening. Export restrictions are live. Industrial demand is accelerating from solar, EVs, AI infrastructure, all metal hungry. Physical premiums refuse to normalize. This isn't a price spike yet. This is a positioning event. If you're holding silver, watching commodities, or stacking anything tied to inflation hedges, this matters now, not next quarter. Now. Your job isn't to predict where price goes. Your job is to understand what's already moving before the crowd notices anything changed. If you're here early, you're ahead, but only if you learn the pattern before the headline hits. Hit subscribe. You're joining a group that tracks structure, not noise. We watch what others ignore. Let me show you what I'm seeing. JPMorgan didn't wake up one day and flip bullish on silver. This was methodical, over years. They accumulated while maintaining short positioning in futures, classic hedge fund playbook. Suppress volatility, control narrative, absorb physical at subdued prices. The endgame wasn't suppression, it was accumulation. Now they're sitting on a stockpile that dwarfs most national reserves, and global supply is tightening from multiple angles at once. China implemented export restrictions on antimony, critical for silver refining. Industrial offtake is quietly outpacing replenishment. Warehouse movements show concentration, not distribution. COMEX registered inventory, the metal actually available for delivery, keeps draining relative to eligible stocks. Futures positioning flipped from net short pressure to controlled long exposure. Physical premiums that should have collapsed by now, still elevated. Lease rates, what it costs to borrow silver for delivery, showing stress beneath paper liquidity. Most people watch price. The real story is flow control. Here's the hidden layer. When one dominant player controls exit doors, price doesn't warn you. It settles, then it reprices, fast. And that's the pattern I need you to see. Imagine a fire hose. Looks full, good pressure. Then someone upstream closes a valve you can't see. For a while, nothing changes. Pressure holds, flow continues, then it doesn't. The hose goes limp instantly. That's what I call the liquidity illusion trap. Paper markets create the appearance of abundant supply, while physical markets quietly drain. Futures, ETFs, unallocated accounts, they expand to meet demand. Price stays calm, risk builds silently. This isn't conspiracy theory. It's incentive structure. If you're a major accumulator, you don't want price running away during the accumulation phase. You want stability. You want sellers. You want time. So you provide paper liquidity, derivatives, warehouse receipts, futures contracts, while absorbing physical metal. The market sees deep order books and assumes supply is plentiful. It's not. It's just available in a different form. Think about that. When stress arrives, industrial demand, spike, refining bottleneck, export restriction, delivery squeeze, the paper doesn't deliver. Can't. It was never designed to. Here's where retail usually loses time. They assume price reflects available supply. It doesn't. Price reflects perceived liquidity. And perception lags reality by months, sometimes years. We saw this pattern in palladium in 2019 to 2020. Industrial demand from auto catalysts met Russian export uncertainty. Price looked stable for months. Then it ripped from 1,400 to 2,800 in under a year. Nobody rang a bell. We saw it in lithium. Battery demand accelerated while new supply lagged permitting timelines. Price ground sideways, then snapped. Same movie, different asset. Silver's showing the same fingerprints now. Not saying it plays out the same way, could reverse, could grind sideways for years. But the structure is there. Paper supply expanding, physical supply tightening. Concentration increasing. Your job isn't to know what happens next. Your job is to recognize the pattern while it's forming, not after it's resolved. Large players don't just suppress volatility, they restrict flow. Here's how what I call the inventory valve works. First, you absorb marginal supply, metal that would normally circulate between industrial users, refiners, dealers. You take it off the table, quietly, over time. Second, you maintain price stability through derivatives positioning, short futures, long physical, hedge the book, contain volatility. Sellers stay comfortable, supply keeps coming. Third, and this is critical, you wait until marginal supply disappears, not until price moves, until available metal runs thin. Then the valve closes. Suddenly, industrial users who relied on just-in-time delivery face delays. Refiners who assume metal was fungible hit allocation limits. Dealers who ran unhedged books scramble for physical. Price discovery doesn't happen gradually, it snaps. Because when flow gets choked, the only way to clear the market is through violent repricing. There's no gentle equilibrium adjustment. Markets don't politely negotiate when someone controls the spigot. Circle this. Price lags flow. Always. By the time price reflects supply stress, the best positioning already happened. The crowd shows up late, pays the spread, and wonders why the smart money isn't buying anymore. Imagine you're an industrial fabricator. You've been ordering silver for years at stable prices. Premiums are predictable, delivery is reliable. Then one month, your supplier says allocation is tight. Premiums spike, delivery windows stretch. You don't care what futures are trading, you need metal now. That's when price catches up. Here's what you need to sit with. The central question isn't, will silver go up? The real question is, what happens when industrial demand meets restricted flow while one entity controls the release valve? If physical supply is genuinely tight, and lease stress, premiums, and inventory data suggest it might be, then someone holding 750 million ounces doesn't need to do anything. They just wait. Wait for industrial users to bid higher. Wait for ETF demand to discover physical scarcity. Wait for derivative holders to learn the difference between paper exposure and deliverable metal. Could take months, could take years, could unwind tomorrow if accumulation reverses or new supply floods the market. But if it doesn't, then price isn't being suppressed anymore. It's being managed, and the exit door is narrower than the crowd assumes. I'm not predicting outcomes. I'm watching signals. Here's how this could play out. One path is an orderly grind higher. Industrial demand absorbs available supply. Premiums stay elevated but stable. Price trends up gradually as marginal buyers compete for flow. JPMorgan monetizes inventory slowly, maintaining control. Volatility stays contained. Retail stacks at higher prices, no fireworks. Who wins? Patient accumulators. Long-term holders who bought structure, not headlines. Who loses? Traders chasing momentum that never arrives. Another path is a sudden repricing event. A catalyst, export ban expansion, refining bottleneck, large ETF conversion to physical, COMEX delivery stress, forces price discovery. Silver gaps higher overnight. Premiums explode. Retail panics in. Smart money already positioned. Volatility rips both directions. Who wins? Those who built positions before the catalyst. Who loses? Those who wait for confirmation. The third path is prolonged suppression. New supply comes online faster than expected. Industrial demand softens. JPMorgan unwinds gradually. Paper markets absorb selling pressure. Premiums normalize. The accumulation thesis breaks. Price chops sideways for years. Who wins? Traders who stayed flexible. Those who hedge tail risk. Who loses? Leverage bulls who bet on imminent explosion. I can't tell you which path we're on. Nobody can. But I can show you what separates them. Not telling you what to buy, showing you what to watch. Look at COMEX registered versus eligible inventory. Normal behavior is registered deliverable metal stays between 30 to 40% of total COMEX stocks. Eligible, stored but not available for delivery, absorbs fluctuations. Stress behavior is registered inventory drops below 25% of total, while eligible stays flat or rises. Means metal is present but not available. Flow restriction in real time. You can check this on CME Group reports, updated daily. Track the ratio, not absolute numbers. Watch physical premiums versus futures stability. Normally, spot premiums trade within 3 to 5% of futures. Basis stays tight. Arbitrage keeps them aligned. Under stress, premiums spike to 8 to 12% or more, while futures grind sideways. Means physical is scarce, but paper markets don't care yet. Divergence before repricing. Check dealer sites, bullion aggregators. Compare 1,000-ounce bar premiums to front-month futures. Pay attention to CFTC positioning shifts among commercials. Normal behavior is commercial traders, producers, industrial users, banks run net short. They hedge production and inventory. Stress behavior is commercials flip net long or reduce shorts aggressively, while non-commercials, specs, funds stay neutral or short. Means the people closest to physical supply are repositioning. Check the CFTC Commitments of Traders report, released Fridays. Watch commercial net position changes week over week. Track China export policy headlines. Normal is incremental policy adjustments. Refiners maintain global flow. Stress is broad restrictions on antimony, refined silver, or rare earth inputs critical to silver processing. Supply bottlenecks multiply fast. Check Reuters, Bloomberg, Chinese official announcements. Keywords are export controls, antimony, refined metals. Watch industrial demand tied to solar, EVs, AI infrastructure. Normal is steady demand growth. Incremental buildouts. Stress is accelerated government mandates, supply chain urgency. Multi-year procurement contracts announced. Demand becomes inelastic. Users need metal, regardless of price. Check trade publications, government policy releases, earnings calls from solar manufacturers and EV producers. Your job isn't to predict which signal fires first. Your job is to know what normal looks like so you recognize stress when it shows up. Not advice. Pattern recognition. If you're a trader, respect volatility windows. Silver can chop for months, then rip 20% in 2 weeks. Position size for whipsaw. Use stops that account for overnight gaps. Don't assume liquidity will be there when you need it. If you're a long-term holder, accept that timing is unknowable. Build positions during low volatility. Scale in, don't lump sum. Physical premiums are your real cost, not spot price. If you're watching from the sidelines, understand asymmetry. The downside case is mean reversion to historical ranges, painful but survivable. The upside case is flow disruption during industrial demand spike, violent and fast. Position accordingly. Here's what I'm not doing. Leveraging into a thesis that requires perfect timing. Betting on conspiracy theories. Ignoring the possibility that I'm wrong. Here's what I am doing. Tracking signals that separate scenarios. Building optionality without needing to be right immediately. Staying informed while others watch headlines. Could reverse tomorrow. Could grind sideways for years. Could snap violently on a catalyst nobody sees coming. But if you track flows instead of price, you're ahead of the curve. Not gambling, watching. The biggest wealth transfers don't announce themselves. They settle quietly, then reprice fast. If you're watching structure instead of headlines, you're already in the group that doesn't get shaken when volatility arrives. You know what signals matter. You know what normal looks like. You recognize stress before it becomes consensus. That's the edge, not prediction, recognition. If you found value here, hit subscribe, drop a comment, binary question. Do you watch price first or inventory? And if you've seen this pattern play out elsewhere, palladium, lithium, oil, whatever, share the story. We learn faster together. Final thought. JPMorgan didn't accumulate 750 million ounces because they like shiny metal. They accumulated because they know something the crowd hasn't priced in yet. Your job is to figure out what that is before everyone else does. Links in description. Stay sharp.